Joining us right now to talk more about the credit market, corporate debt, and more, Tom Tezoris is here. He's the director at Strategas. Good morning to you.
Good morning.
You heard what Paul Tudor Jones had to say.
Yep.
You were just listening to the interview with the vice chair now of the Fed. Who are you in agreement with?
Not really either. I'd say clearly this is a bigger problem than General Electric. This is a bigger problem than just slowing growth. We have too much debt. That's absolutely true. But the market is also very much concerned, and I might take issue with some of the previous comments from the Fed vice chair. The market is very concerned that the Fed is going too fast or will go too fast. So you combine the two and you've got a bigger problem than by itself either one would add up to. So here's the real problem when it comes to debt. 50% of the investable corporate bond space, investment grade, is BBB rated. That BBB rated debt is, on average, every business cycle gets downgraded, 10% of it gets downgraded to junk. Well, that means this cycle, if 50% is BBB rated, and that's about $2.5 trillion, about 10% of that gets downgraded to junk. Even if we have a lower amount downgraded, you're talking about a $200 billion increase in junk float. Well, just from concession alone, that means high yield spreads have to widen about 100 basis points. And it probably also means that investment grade spreads need to be about 10 basis points higher. Now, those are levels the market can handle, assuming the Fed doesn't over-tighten. If the Fed over-tightens, then it becomes a problem because now the market has to digest that new float into a recession. So they're related. And I don't think you can separate the two. And this is why it's bigger than just GE.
Tom, Joe had a really interesting point.
Can't believe we can choke off an economy at 3%. I just don't know what's different about.
Well, I don't think we can choke off the economy at 3%. I think the market is concerned the Fed is going to go to 3.5%.
Okay, 3.5 chokes the market?
3.5 chokes
What's
the market.
What's different then? I was saying, and maybe someone's making sense here, and that is, they see the Roach Motel, we stayed at zero so long, we checked in, we're never going to check out.
Yeah.
Now we're trying to get out, and you can't even get to 3. Did too much debt get built up with all the free money? So now if rates go up,
not
they
just corporations, between consumers.
Everywhere, globally, governments, everything.
Here's the real problem. It's not the level of interest rates that really matters so much, it's the pace at which you get there. And that matters for two reasons. One, for Main Street, there's an adjustment from a quick jump up in rates. But also, Wall Street is not priced properly or priced correctly. That is, both bonds and stocks are not priced correctly if you have a volatile move in yields. And that volatile move in yields could be driven by the Fed or inflation. So we're stuck at we have to stay at Goldilocks.
I understand that for corporations and even consumers, but I think if you look at government debt, you're facing a big problem no matter how slowly you get to those sort of interest levels. If we suddenly have to pay back 3.5%, 4% on what we've already borrowed, we're in big trouble as a nation.
Well, that's very true, but I'd say that's more of a problem for the municipal space than the federal government space. What's likely to happen is if the Fed goes to 3.5%, the 10-year yield's going to go down to maybe 2.5%. And the curve is going to not only flatten, but it's going to invert. And that's another important point that I think the Fed is missing. This flattening curve is not the result of QE, and this negative term premium is not the result of QE.
We keep talking about GE. I'm curious about the oil companies, these highly leveraged oil companies, and what's happening with the price of oil.
Yeah, well, so I think if you look at the spread widening we've seen in high yield, I think a lot of it over the past week and a half has been the result of oil. High yield energy companies make up maybe about 12% of the high yield index. It's down from 20%. So it's not as big of an impact, but clearly energy space is widening out.
Go back to what you were saying off camera, and that is that inflation right now doesn't warrant rates going up much more, and we're continuing, I said this, we're continuing to import disinflation from around the world. They've had trouble, and it's all because of a lack of aggregate demand or something?
Well, I wouldn't say it's all because of a lack of aggregate demand.
It is global now, right? And even when rates are at 0.5% over there, how do we go up over, we do look high compared.
Well, I think growth potential in the U.S. is now shifted higher to about maybe 2.75 to 3%, up from about 2%.
I thought that was impossible with the population and productivity.
Well, I think productivity has shown an uncharacteristic late cycle push.
Okay.
So if you assume productivity is more like 2% right now and is going to find a home around 1.5%, and you got a population growth about 1% or so, you can get to 2.5 to 3%.
2.5 to 3%.
But the problem with that is you can't bring Fed funds rate to 3.5% when your growth potential is only 3% and you only have about 2% inflation in the system. Because what's going to happen if you do that, the curve is going to flatten precipitously.
I want to know if there's any high yield debt you actually like right now.
Not right now, no. I think the space is probably about 40 basis points too rich on an aggregate level. I think that's theoretically optimal. When things start to go south, you're going to see spreads widen out by easily 100 basis points. So we've been pulling back in our asset allocation models. We're down to, in our core strategy, about 1% high yield, which is really the minimum you'd go to. So as a sector, I really would not like high yield, and I certainly wouldn't like higher duration, lower quality high yield.